What's up, everybody? This is Sunko, the Korean bro. Today is 2024, March 20th. And let's look at tonight's news, okay? Two soaring stocks I buy now with no hesitation. Uh, these two consumer stocks have climbed in the double digits this year. Both suffered from a higher inflation in recent years, but managed the tough times well, and their long-term prospects look bright. Target, we have Amazon. Amazon also went through a rough patch in recent years as higher inflation hurt the consumer and made the company's operations more expensive too. But Amazon revamped its cost structure, an effort that has already been bearing fruit and should continue to boost earnings down the road. In the most recent quarter, the e-commerce giant reported net sales declined in the double digits and operating income more than quadrupled. This is thanks to the company's growth in e-commerce, of course, but also thanks to its cloud computing business. Amazon Web Services. In fact, historically, AWS has driven profit in Amazon. And this trend looks set to continue. AWS generated $7.1 billion in operating income in the quarter, representing 54% of total Amazon operating income. Amazon also is benefiting from its investment in the high growth area of artificial intelligence. The company uses AI to streamline operations, saving time and money and keeping customers happy as it delivers packages faster. And AWS sells a wide variety of AI services to customers, from chips and coding companions to a fully managed service that allows clients to tailor top large language models to their needs. Amazon, after rising 15% so far this year, trades for 41 times forward earnings estimate, down from a more than 56 just a few months ago. And that's a bargain for a company that has what it takes to benefit during a bull market or the long hour. So the point here is that because of COVID, it went down a lot, but then it has gone back up recently. And with AWS and all, it's got a lot of potential. Uh, and to the next. Chevron is following leaders ExxonMobil and Occidental Petroleum to capture this $5 trillion potential opportunity. Uh huh. Mm-hmm. Okay, let's read this one. Costco stock is expensive. Investors have to pay a big premium to own it. The company, however, is still growing and has plenty of opportunities to tap into in the long run. Its e-commerce business has been strong with comparable sales growth of more than 18% last quarter. The business is still showing strong member growth. Revenue growth is important for business, but Costco membership growth may be even more crucial. Those are the customers who are signing up for one of its membership and are planning to spend at its warehouses on a regular basis. With a high renewal rate, normally around 90% or better, odds are any new members are going to be customers for a long time. On the company's most recent earnings call, which was for the fiscal second quarter, management said the number of paid household memberships rose by 7.8% year over year. Costco now has 73.4 million paid household members and 132 million cardholders. It's an encouraging sign that even amid inflation, as budgets tighten up, consumers are seeing even value in Costco's membership to sign up. That bodes well for the company's growth prospect this year and beyond. Hmm. Okay. Mm, let's move on to the next one. One no-brainer artificial intelligence stashed value at $25 and hold for 10 years. Let's see what that is. Sentinel 1. Okay. Artificial intelligence is creating a new paradigm in cyberspace, which calls for more sophisticated security. Cybercrime will cost worth $9.5 trillion in 2024, according to an estimate by Cybersecurity Ventures. Moreover, data by McKinsey and Company suggests the corporate sector is on track to spend just $213 billion in cybersecurity this year, which is far below the $2 trillion it should be spending. Clearly it's already more expensive on average for a business not to have cyber protection. With the astronomical cost of cybercrime continuing to rise, the aforementioned spending gap will likely close. SentinelOne is poised to capitalize if that happens. It's a cybersecurity provider with artificial intelligence at the core of its products. And the company continues to grow faster than its competitors. Here's why investors might want to buy SentinelOne stock now and hold it long term. Leader in AI-based cybersecurity. Cybersecurity giant Palo Alto Networks recently highlighted a tenfold increase in the frequency of phishing emails over the past 12 months. Attackers are using generative AI to rapidly craft realistic content design to trick employees into handing over sensitive information about their organization. A recent survey by PwC backs that up. Of the 4,702 leading CEOs who responded, 64% are more concerned about the cyber risk posed by generative AI. The fear outranks the spread of misinformation and even the potential reputational risk posed by using the technology. Automated cybersecurity tools are critical to fend off the barrage of AI-powered attacks. SentinelOne Singularity is a holistic cloud endpoint identity protection platform with AI at its core. The company's unique storyline technology tracks security event data across the entire enterprise and autonomously creates summaries with actionable insights for managers, reduces alert fatigue, which is a serious problem across the industry, as security managers struggle to keep up with the sheer volume of incidents. SentinelOne's Purple AI is another solution to that problem. It integrates with the cybersecurity stack and serves as an AI virtual assistant. It's capable of answering questions, drilling down into specific issues and command, and even running preventive scans for newly identified threats. Purple AI can save cybersecurity managers countless hours of manual investigative work, ensuring fewer incidents are overlooked. SentinelOne is growing more quickly than its competitors. Okay, SentinelOne generated $174 million in revenue during fiscal quarter 4 2024, up 38% year over year. That was a faster growth rate than what Palo Alto Networks and CrowdStrike delivered in their latest quarters. They're two of SentinelOne's biggest rivals in AI-based cybersecurity. The SentinelOne is a much smaller company, which makes it easier to generate higher growth rates. It reported $621 million of revenue for fiscal 2024, which was comfortably above management's most recent guidance. However, Palo Alto delivered $7.5 billion of trailing 12-month revenue, and CrowdStrike generated $3.1 billion in its recently ended fiscal year. Okay. Celsius, Sweetgreen, and Tricot are up between 59.95 so far in 2024. Where's Celsius? Shares of Celsius are sparkling this year, and that's fitting since it's a fast-growing player in sparkling functional beverages. Okay. Premium salad spinner Sweetgreen was a hot dab in when it hit the market $28 in late 2021. Hmm. Can the cheapest Magnificent Seven stock turn $100,000 into $1 million? The market's rally since the start of 2023 can be largely attributed to the rise of the Magnificent Seven companies. Among this coveted group, Alphabet trades at the cheapest forward PE ratio. There are many reasons to believe that Alphabet shares can rise tenfold in the next 20 years. Let's see. You might think these dominant tech-enabled enterprises are expensive, but one company will change that assumption. Since the start of 2023, the market has been on an absolute tear. Mm. The S&P 500 and Nasdaq composites have soared 34% and 54% respectively during that time as of March 18. But it hasn't been a broad-based rally. In fact, the so-called Magnificent Seven stocks, which includes some of the world's most dominant and influential enterprises, are carrying most of the weight, and their market caps are reaching new heights. That doesn't mean these stocks are off limits. Investors should take a closer look at Alphabet in particular, trading at a forward price to earnings ratio of just 12.21.8. This tech giant is the cheapest of all the Magnificent Seven stocks based on the popular metric. Compared to the valuation multiple that uses sales in the denominator, for example, the forward PE ratio can be superior because it emphasizes net income. After all, producing a positive bottom line is a wonderful indicator of a company's ability to be fiscally responsible. Moreover, by looking at forward estimates, we can also incorporate Wall Street's outlook into our analysis. With that being said, it's time to consider adding Alphabet to your portfolio. You could turn $100,000 into cool $1 million over the next 20 years. The loose side of the big picture, Alphabet has been under pressure recently because Wall Street thinks the business is falling behind its peers in the artificial intelligence wars. Especially as it relates to Gemini's image generation tool. Moreover, I believe there are still fears about Alphabet's lucrative cash cow, Google search being disrupted by the advent of AI capabilities. Perhaps this helps explain why shares are cheaper than the other Magnificent Seven stocks. However, there's no reason to panic. Investors would do much better if they spend less time trying to predict or quickly react to the latest news update and focus more of their attention on the big picture factors that matter to a company's long-term success. No matter how you look at it, Alphabet is still a dominant enterprise. Google search rate $175 billion of revenue in 2023, up 7.7% year over year. According to StoreCounter, it is jaw dropping 92% of the global market, despite all of the hype surrounding ChatGPT and its integration with Microsoft's Bing. So, given the tremendous amount of data Alphabet is able to collect, the company can continue to effectively target internet users better than any other platform out there. This means Alphabet will benefit from a strong demand and ad pricing power. There's really no clear evidence that Alphabet's crown jewel is under threat. The company's wide economic moat, which is supported primarily by the network effect, will continue to protect it as new tech innovations rise. Betting on a tenfold gain. And in just the last 13 years, Alphabet's stock has risen by almost 900%. If shares were to climb tenfold in the next 2 decades, it would translate to an annualized gain of a 12.2%. I believe that's a totally reasonable outcome. Investors could get some added outside should the valuation expand over time. Even if the multiples end up not being a major factor, the business itself has solid growth prospects. The amount of internet data and number of users continue to grow. With each passing year, this creates the foundation for Google Search to organize and serve update info. Alphabet also owns YouTube, the leading video streaming service provider, and not only has an estimated 2.5 billion users across the globe, it commands the most TV viewing times of any other streaming platform out there. As more time is spent watching streaming content, more and more dollars will flow this way. There's also Google Cloud, which is about 11% worldwide market share in the cloud computing industry. Revenue was up 26% in quarter four, faster than the business overall. And given the huge runway for IT spending to shift to off premises, there's ample opportunity for sales gains to continue. Hmm. Okay, let's see. Where will Tesla stock be in 3 years? Tesla shares are down 60% from all-time highs, while the broad market is soaring. The company is growing its production volumes, but drastically cutting its selling prices. The stock market looks expensive. The stock still looks expensive on a 3-year time horizon. Low profits have driven the stock lower. Is this temporary or a sign things that have changed? The stock market is soaring yet again, but this time Tesla is not leading the change. In fact, the market up in spite of the electric vehicle litter. Okay, tonight I'm so tired that I'm tired. I'll just skip and leave it as it is. It's now past 15 minutes and I'm getting hella tired. I'll come back tomorrow and see you guys Sunday night, okay? Bye bye, everybody. Bye bye.